So, why does investing feel so hard for so many people? You start out with good intentions, maybe trying to build some security, but then somehow things go off track. It feels like you're missing something crucial.
Yeah, it's a common frustration. It trips up beginners, definitely, but even people with some experience struggle. And today, we're doing a deep dive into why, using insights from some really foundational investing texts.
Like common sense on mutual funds and the ideas and security analysis, those classic.
Exactly. The mission here is to unpack why people often stumble based on what these sources tell us are the common pitfalls,
Yeah.
and then maybe show the surprisingly straightforward path they actually recommend.
Okay, sounds good. So, uncovering the reasons for disappointment and hopefully how to avoid them. Where do we start? What's a major pitfall?
Well, maybe the single biggest one, the thing that works against you constantly, is just costs.
Costs, like fees and things. Seems simple, but these books really hammer this point home, don't they?
Oh, absolutely. They call it fiscal drag. And it's not just one thing. The fund's operating expenses could easily be 1% a year, 100 basis points for equity funds. Then there are transaction costs when the fund buys and sells.
Right. The trading costs.
Yeah, maybe around 0.8% per trade value, they estimate, plus taxes. Individually, they might seem small.
Uh-huh. But they add up, that compounding effect, but working against you, the
Uh,
tyranny of compounding
Right,
there.
precisely. Over the long haul, it's huge. There's this great example in the source material. Imagine $10,000 invested in a simple low-cost index fund. It might grow to, say, $153,000 over many years.
Okay.
But in a typical actively managed fund, with those higher costs dragging on it year after year, that same $10,000 might only become like $113,000.
Uh-huh. That's nearly $40,000 less, just gone to cost.
Just gone. It completely reshapes your final outcome. So costs are massive. That's pitfall number one.
Okay, so costs are critical. What's another big reason people fail, according to these sources?
Well, another one is chasing unrealistic performance and getting tangled up in complexity.
How do you mean? Like trying to find the next hot stock or something?
Sort of. Or constantly switching funds, trying to pick the winner based on recent returns using short-term tactics. The investment industry often pushes this idea, but the sources show it's often a losing game.
Is that where things like fund ratings come in, like those Morningstar stars everyone sees?
Exactly that. The sources are pretty blunt systems, like the Morningstar ratings. They have very little power to predict future returns.
Really?
Yeah. Chasing those stars, trading based on past performance, it often leads to worse than market returns, and sometimes with more risk. Trying to overcomplicate things, looking for some secret edge, it just makes disappointment more likely.
So trying to be too clever actually backfires.
That's the message, loud and clear. One source basically says, the secret of investing is, finally, that there is no secret. Simplicity, not complexity, is your friend.
And this ties into those really old school principles too, right? Like from security analysis, ignoring the fundamentals.
Yes, absolutely. That's another major pitfall, getting swept up in market noise, price swings, speculation, rather than focusing on the actual underlying value of the business you're buying into.
Like focusing on the stock price instead of the company.
Right. Markets can go nuts, swinging from fantastic inflation to equally fantastic deflation, as one text puts it. The key should be understanding what you actually own.
Okay, makes sense. And the last big trap you mentioned, that temptation of active management.
Yeah, the allure of beating the market. The problem is, very few active funds actually deliver returns high enough to justify their higher costs over the long run, compared to just tracking the market with an index fund.
So the math is just tough for them.
It really is. Think about it. All investors as a group have to underperform the market average by exactly the amount of their costs, fees, trading, everything. So paying more makes it inherently harder to keep up, let alone beat the market consistently.
Okay, so we've got high costs, chasing performance, complexity, ignoring fundamentals, and the tough odds of active management. That covers a lot of ground for why people might struggle. So what's the path forward these sources suggest? The simpler way.
It really boils down to discipline and, well, simplicity. First off, make low costs your absolute priority. Minimize that fiscal drag we talked about.
Okay.
The data highlighted in the sources is pretty compelling. Low-cost funds, on average, just do better than high-cost funds after you account for expenses.
So focus on keeping fees down. Index funds come up a lot here, right?
Definitely. The sources make a very strong case for indexing. Just aim to capture the market's return, cheaply and reliably. Even investing giants mentioned in the text, like Peter Lynch and Charles Schwab, endorse it.
Just take what the market gives you reliably and cheaply. Don't try to be a hero.
That's a huge part of it. Second, focus on the long term. Be patient. Invest for years, decades even. Let the market cycles do their thing rather than trying to constantly guess the next move.
Patience and time.
Hmm?
Crucial.
Absolutely. And finally, know what you own. Connects back to that value principle. Understand the business behind the stock ticker. Don't just chase price momentum.
Got it. So let's recap this deep dive. Based on these classic sources, a lot of investor failure isn't because investing is impossible, it's because people fall into these traps. High costs, complexity, short-term thinking, chasing hype, instead of sticking to simple, long-term value principles.
Exactly. The path they lay out is almost boringly simple. Keep costs incredibly low, stay diversified, think long-term, understand your investments.
It really shifts the focus from trying to be smarter than everyone else to just being disciplined and avoiding those common mistakes.
Right. Minimizing the hurdles, letting time and compounding work for you, not against you.
Which leaves us, and you listening, with a really interesting thought. If the evidence from data and the wisdom from these foundational texts points so clearly towards low costs and simplicity, why is the investment industry still so focused on promoting complex, often high-cost strategies? Something to chew on.